Welcome, everyone, to our webinar. This is Nathan Mercereau, President of Planning Alternatives, and we're delighted that you're joining us today for an exclusive event for Planning Alternatives clients and guests. Our webinar series is a great experience for our clients throughout the country who can join us remotely and listen in and engage in great content. So we're delighted that you're with us today. We'll be recording this webinar so that you can listen to it later, view it later, or even pass it on to other guests. Planning Alternatives was founded in 1982. We are a fiduciary wealth management firm based in Michigan, but we have clients throughout the country. And we work with individuals and families to create wealth management solutions that encompasses their entire life. And in fact, our mission statement is to empower you to live the life you value. So the work that we do here is for the benefit of our clients to live a fulfilled life and have peace of mind that everything is in order regarding their financial world. So our webinar series is a step in providing education and insight to help you get clarity about what's going on in the financial markets. We also offer webinars that talk about financial planning strategies, and look forward to continuing the conversation through future webinars. Want to encourage you, if you're listening today and have a question, you can submit your questions online, and we actually see them here on our end as they come in. And at the end, we'll have a Q&A session, so feel welcome to submit questions along the way. And I want to just give a quick overview of our agenda. Jim Long, our Director of Investments, will be introducing our guest speaker, and then our guest will be providing insight and commentary, and then the Q&A session will be at the end. So without further ado, I'd like to introduce Jim Long, our Director of Investments here at Planning Alternatives, who will share insight around our guest speaker.
Thanks, Nathan, and good day to everyone joining us today for our webinar series titled, Will Politics Trump the Global Economy? And our guest today is Jeff Kleintop, Senior Vice President, Chief Global Investment Strategist for Charles Schwab and Company. And in this role, Jeff analyzes all financial markets, identifies trends, he provides research and commentary, and works closely with advisory firms like ours here at Planning Alternatives throughout the year, and especially with events like this that are client-focused. Jeff's had a long and distinguished career. He's studied and lived around the world. He holds degrees from University of Delaware, Penn State University. He's studied at the London School of Economics, and he's a CFA charter holder. Jeff's work has been featured in publications like the Wall Street Journal, New York Times, Barron's, and he's a regular guest on programs on CNBC, Bloomberg, Fox Business News, among others. So it's a great treat for us to have Jeff with us today for this webinar. And Jeff, we'd like to welcome you, and thanks so much for joining us.
Thanks, Jim, and thanks, Nathan. I'm thrilled to be here. I don't get to do this as often as I'd like. As you mentioned, I do a lot of TV, a lot of media, but I don't get the opportunity to get in front of individual investors as often as I'd like to and hear feedback from them, where their heads are at, what they're thinking about, what they're worried about, what they're excited about. And I'd love to get into that in the Q&A. So I know we're going to set aside some time up front here, 20 minutes or so, 15, 20 minutes for me to kind of go through how I and Charles Schwab kind of seeing the world right now, the intersection of politics and economics and markets. And then, Jim, I know you and I are going to have a bit of a discussion. And then I'd really love to hear from everyone out there and where their thoughts are right now in this rather unique time with stocks at highs, yet increasing concerns and pressures from everything from trade to central banks to geopolitical factors. So much going on right now. I'm really excited to hear from all of you. Again, I don't get to do this often, but when I get the opportunity, when Nathan comes to me and says, "Hey, Jeff, would you do something like this?" I jump at it because I think the thoughts you're gonna share and the questions you might have are probably really at a very good level and very reflective of some of the smartest investors out there and where their heads are at. Again, I spend a lot of time talking to the media, a lot of time talking to other investment professionals. Love to hear from all of you. Anyway, long story short, let's get started. So I want to kick off with a chart here, and it's a unique chart. It's this blue line here, and I'm not predicting anything with this chart. I'll get to that a little later on. But this chart, I think, is an interesting one as it relates to the late stage of the global economic cycle. I think we are in the late stage. I don't know if we're at the end of it. I don't know if we're beginning the late stage, but we're in that kind of later stage. And this is usually what happens to the stock market. Now, this is looking at the last 6 global recessions. So this is the last 50 years worth of data in one line. And what that line is telling us is if you look down the middle of the chart, you see 0 at the bottom. That's when the recession is dated to start. You'll notice that stocks begin to fall before the recession starts, about 26 weeks, about half a year before the recession starts. But back up and take a look at the whole pattern. Stocks go up about 30% in a year and a half before the recession begins. 130 weeks before the recession begins, stocks go up and up and up, and they're up about 30%. And then they give all of that back again on average over that sort of year and a half, kind of half a year before the recession starts to a year after it ends, to a year after it starts. And then from that year after the recession begins, over the next year, from 52 weeks to 156 weeks, that's 2 years, gets it all back again. So up 30%, down 30%, up 30% again, okay? That's really simple, but that's what I'm talking about here, that pattern. Now, I want to take you to what the stock market has done this time, and that's this purple line on the next slide here. Look at this. This is remarkable. Again, I'm not necessarily predicting anything with this chart, but what you'll notice is that this particular cycle has retraced that line so closely until this year. Look at this, up that 30%, right, and then kind of wavering a little bit, and then pulled back late last year. It seems like forever ago now, but in the fourth quarter of last year, we saw a nearly 20% decline in the stock market here in the U.S. and abroad. This, of course, this index I'm looking at is the MSCI World Index. So that includes the U.S. at about 65% of that index are U.S. companies. But I wanted to show you that this is a global phenomenon. It's not just the S&P 500 or Dow. But look, as of the end of last year, that purple line had come down to where the stock market was telling us the next recession had begun. We had crossed week 0, and we were into the next global recession. Stocks were convinced the next big downturn, bear market, global recession had begun. But then we had the Fed step in. Forget all these questions about trade and other issues associated with the Trump administration and focus on the Fed for a second. The Federal Reserve came out and said, you know what, we're done hiking interest rates. December was the end. And we might even cut rates later this year. Well, stocks love that news. The idea that maybe the Fed would step in, cut interest rates, and lengthen the economic cycle. And stocks rocketed all the way back to their highs again. So stocks went from late last year pricing in the start of the next recession to, well, as of right now, saying, no, there's no recession in sight. So I think this is fascinating. And I think this idea, and I really do think it has to do with the Fed, this idea that a few rate cuts by the Fed could eliminate any risk of recession. And I'm not saying it's already started or even about to start in the next month or two or next quarter or two, but the idea that the Fed can alleviate all of the potential pressures here weighing on the economy is maybe putting a bit too much confidence in the Federal Reserve. Let me go through the things I think are stacked up against a few rate cuts here as we go to what I'm watching in terms of the global economy. I've got a few slides I want to share with you. And this first one is the global leading indicator. There are lots of leading economic indicators usually compiled for an individual country. This is the one for the entire globe. It's put together by the OECD, that's the Organization for Economic Cooperation and Development. It's a big think tank, been around for many, many decades. And they do leading indicators designed to tell us where an economy might be headed in the next 6 to 12 months for every major country in the world. But they also do this one for the entire world. Now, you see I drew that dotted line across at 99 because 99 on this index is such a critical level. If you look back, you'll notice that every time that blue line crossed down below 99, we got a recession. We got one of those shaded columns, and recessions are when the global economy is shrinking. We're losing output, we're losing jobs, profits are usually falling sharply, and of course the stock market tends to fall pretty sharply as well, as I noted in that first slide. So 99 is a very important level. As of the latest reading, we're at 99.03. About as close as you get to 99. Now, we haven't broken down through it yet, but so close to it. I'm worried that we're perhaps nearing the threshold of the next recession. If you look back to 1998 on this chart, we got there. We got just about to 99 and then rebounded. We got another year of great returns in the stock market in 1999, and we got another year and a half or so of economic growth. That might be the case again this time. I'm watching very closely because this indicator, as you can see, is a good 50-year track record of telling us when we should be worried about the global economic situation. But let's break this down a little bit further and go to the next slide, which looks at manufacturing around the world. Now, this is where the weak spot is concentrated today. Right now, the weakest area of the global economy, and in pretty much every individual country, including the US and Europe and Japan, is in the manufacturing sector. This is an index called the Purchasing Managers Index, where they survey purchasing managers at manufacturing firms about the trends in their business. And what I want you to focus on is that big dropping red line there at the end of the chart. That's 14 months in a row of a declining Purchasing Managers Index. That's all this chart's telling us. The green just shows whenever there's month after month of increases in the index, and red just shows every time we're getting a number of months in a row of decline. This is a record. We've never seen 14 straight months in a row of declining sentiment on manufacturing. So clearly a sign that manufacturing is in recession, and that's an important leading indicator for profits here as we enter the second quarter earnings reporting season and begin to get guidance on the second half of the year. I'd note that right now, analysts for S&P 500 companies and others are expecting a pretty sharp rebound in profits towards the end of this year. Double-digit earnings growth is expected by analysts for the fourth quarter of this year compared to the fourth quarter of a year ago. I don't know where that's going to come from if we continue to see numbers like this. So I'm a bit worried about the vulnerability of those forward earnings estimates as we progress through the earnings season here, as we continue to see these declines. So room potentially for some disappointment in guidance as we go through the next few weeks. Okay, so the next slide really takes us a step further and focuses on the confidence of CFOs. Now, this is a survey done in June by CFO Magazine in conjunction with Duke University. Now, they do a great job, and they've done this for many, many, many years, surveying CFOs, thousands of them, at companies here in the US and Europe and Asia, all over the world. And you can see I've broken it down here across the bottom. What you'll notice is the percentages of CFOs surveyed that believe we're going to see a recession by the middle of next year or by the end of next year is 50% or higher, just about everywhere. Even in the US, nearly 70% of CFOs think we'll see a recession by the end of next year. Now, I'm not suggesting that they're right, because they've never been right. Frankly, they don't have a good track record. But that's mainly because they've never predicted one before. They've never been accurate in predicting one that actually came. What's fascinating to me is that CFOs are very defensive right now in believing that we may be on the cusp of the next recession. And I'm less concerned about the accuracy of their forecast and more concerned about what they might be doing to prepare for that outcome. CFOs are a lot less likely to, approve new hiring, buying a new truck, expanding a factory, if they believe we're on the cusp of the next recession. And I think this just further exacerbates this manufacturing slowdown, and that businesses are unlikely to do a lot of spending here over the course of the next few months. In fact, we've seen in the next year, and we've seen this begun to show up in some of the capital spending data that businesses are really beginning to slow or even pull back. And in fact, in some of the latest job layoff survey data, they've really spiked up. The number of layoff announcements has really picked up pretty sharply. We haven't seen the layoffs yet. Job market still looks good, but pre-announcements, large companies are required to pre-announce layoffs. They really picked up a little bit. So I'm worried about how CFOs are beginning to brace for the potential of a downturn next year, and worried that it might even become self-fulfilling. But what about the consumer? Let's go to the next one. So we know business leaders are cautious, and that's a worrisome sign. But consumers are optimistic, and that's a worrisome sign as well, unfortunately. You'd think in global economies like U.S. and Europe and Japan that are still driven by consumer spending, strong high levels of consumer confidence would be considered a good thing. But unfortunately, better growth is usually associated when confidence is low and rising rather than when it's high and falling. If you take a look at this chart, and I just put U.S. and Europe on here, but I could have put a number of other countries as well. The pattern is quite similar. If you'll notice, consumer confidence is usually high right before we get to those gray shaded areas that mark recessions, right? Where we have bear markets and lost jobs and everything. People are usually confident right before the bad times begin to emerge. And we've recently hit levels in Europe and the U.S. that we saw pretty much, ahead of the last three major global downturns, right? The recessions we saw in 1990, in 2001, and of course in 2008 and 2009. So we're back to those levels and starting to see confidence slide. This worries me as well, that consumer confidence is vulnerable at a time where businesses may be pulling back, and trade is obviously also a major concern as well, with trade growth slowing. So if we don't have trade supporting the economy, businesses are pulling back, we're increasingly reliant on the consumer, and I'm concerned that they're vulnerable here. So where do we go from here? If we take a look at the next slide, I think this is something that's gotten so much attention lately. If you've ever seen me present before, you've seen it before. I think it sums everything up. This is the yield curve. Now, I'm referring to the blue line across the bottom. What's the yield curve? So it's the difference between long-term and short-term interest rates, right? The 10-year yield minus the 3-month yield on government bonds. Usually the 10-year yield is higher than the 3-month yield, so usually that number is positive. But sometimes, rarely, the 10-year yield drops below the 3-month yield, as it is today. And when that happens, we call it an inversion of the yield curve. Usually it reflects an imbalance in the economy. Things are heating up in the short term. Short-term interest rates have risen, they're higher. In longer-term interest rates, because businesses aren't spending, people aren't borrowing as much, those rates are coming down. And usually that's rectified in the form of a recession. If you'll notice on my chart here, every time that blue line dropped below zero, meaning the 10-year rose above the 3-month yield, I marked it with a little orange dot. Every one of those orange dots comes about 12 months before those gray columns, before those recessions. So you'll see every one of those 7 recessions was preceded by almost exactly a year by those orange dots. And what's made even more important to us as investors is that I drew an orange line up from those dots to show you that while those inversions came about a year before the recession, they came pretty close to the peak in the stock market, usually within a few months of the peak in the stock market. And that's what worries me today. The yield curve has once again inverted, has done this now for the last month or so. Could that be telling us we're at or near the peak for the stock market? In this case, the index is the S&P 500, but I could have put the world index up here as well. It works just as well for the global stock market as it does for the U.S. The U.S. yield curve is a pretty good global economic indicator. So this sounds pretty rough, right? So we're looking at a lot of indicators that have a pretty good long-term track record of suggesting that there are some things to be worried about. The economy is slowing. The consumer is vulnerable. The global manufacturing output is shrinking. It has been for 14 months in a row, beginning to weigh on profits. CFOs are becoming more pessimistic and pulling back on spending. It's a lot to stack a few rate cuts up against. Not to saying it might not work, it may work, but I think that we may end up in some form of slowdown. Earnings are flat here for the second quarter in a row, as they're likely to come in for the second quarter. We may see more of that in the second half. We may even see outright earnings decline. So I think a more difficult stock market in the second half of this year is more likely than the big gains we saw in the first half of this year. In the first half of the year, obviously priced in the fact that we hadn't already entered a recession and that the Fed might be on our side instead of continuing to hike rates. Now that we've priced all of that in, I think the turn to how much of a downturn might there be, how much of a slowdown might there be, and how much can the Fed do to offset that, I think, are the key questions for the second half. So what do we do about that? Let's talk about what we do about that, and then I want to talk to Jim a little bit. So if we move to this idea of how do we invest in this kind of an environment on the next slide, the first thing that I think about is, what about big trends in asset classes? I mean, I know we might want to first think about, oh gosh, should we be in the market or out of the market? I don't think that's a great thing to first consider for a number of different reasons. One is that getting out of the market is fairly easy. Getting back in is really hard. I don't have a single chart that tells us when the coast is clear. All these charts I showed you tell us where pressures are increasing in the later stages of the cycle, when we might be on the cusp of a recession or bear market, but none of them tell me when to get back in. And that's the much harder decision. So I want to focus a little bit on the idea that maybe we just want to avoid some of the more vulnerable parts of the market and instead focus on those areas, or look for diversification in those areas that may be better positioned. And that brings me to this growth and value chart. We know that over the long term, there are periods where growth stocks outperform, and in long periods where value stocks outperform. Of course, the difference is just growth stock grows really quickly, but you pay a high price for it. Value stocks are value. They're cheap, but the companies tend to grow a little bit more slowly. And markets tend to favor one versus the other for certain periods of time. So I've got this chart here going back about the last 30, 35 years or so, because I wanted to show you what this looks like, these long cycles. When the blue line is going up in this chart, growth stocks are outperforming value stocks. And when the orange line is going up, value is outperforming growth. So if you remember back to the 1990s, growth stocks, led by the tech sector, were the place to be, right? Tech stocks really outperformed, leading growth to outperform, and that line really widened out. The gap between growth and value stocks got really wide. And then it suddenly started to close again. And that was right around the time when the yield curve inverted. Now you'll notice I've shaded these columns in blue instead of gray because they're not recession. What I shaded here were periods where the yield curve inverted. Remember, where the 10-year yield dropped below the 3-month yield. And they were signals, or maybe even verifications, that we were starting to see a shift in this long-term performance. So we got this shift in 2000, and that really marked the start of a long shift where value stocks then began to outperform growth stocks, led by the financial sector, kind of a classic value sector, until we got the next yield curve inversion. And then once again, there in 2006, 2007, we started to see this shift where growth stocks then began to reverse again and start to outperform value stocks. I could take you back 50 years on this, but I just wanted to show you these periods we all kind of remembered. And for the last 10 years, that blue line's been going up. Growth, led by tech, has been outperforming value by, once again, a very similar margin to what we saw back in 2006 and 7, and of course, 1999 and 2000. It might suggest it's near reversing again. And once again, we are at a period of inversion in the yield curve. Why does that matter? Why does the yield curve seem to signal these times when we get these reversals? I think it has to do with the resetting of expectations. When we get a yield curve inversion, markets begin to reassess the outlook for growth, right? Usually growth of the entire economy and earnings, etc. But those areas of the market that have really outperformed, where optimism and future growth may be the highest, tend to suffer the most. And so in this case, it would likely stand to reason that growth stocks, maybe led by the tech sector, are the most vulnerable to resetting of expectations as we move through this yield curve inversion. So what this would suggest is that value stocks might be on the cusp of a comeback, and making sure your portfolios are rebalanced between growth and value is really important. I often emphasize this fact to investors who are left to their own devices. They just let growth go, right? Just, hey, hang on to those winners. That's what people do in general. Even when markets get difficult, they just sort of focus on what had been working in their portfolio and fail to recognize that there may have been a major shift in performance. And so, again, my only emphasis here is we all want to make sure that we've got a balance between growth and value in our portfolio and haven't drifted too far towards the growth spectrum, given that growth stocks may suffer worse than the overall market if we do suffer a recession and bear market. So that was long. Let me be quicker on the next two. So small versus large company stocks, similar pattern here. Maybe a little bit of a smaller scope, but you can see again around periods of yield curve inversion, those shaded areas, large company stocks, that's when the blue line's going up, have outperformed, and then we saw the reversal where the orange line started going up and smaller company stocks began to outperform. For the last 10 years, it's been all about small company stocks. For a variety of reasons, I think having to do with very easy credit conditions. Small companies are much more dependent on borrowing. So when banks make borrowing conditions very easy, interest rates fall to zero, the Fed is lowering credit spreads, all that really helps smaller companies in their borrowing. Now that rates have gone up, credit spreads have begun to widen, and banks have begun to raise lending standards, it's gotten a bit tougher, and already we've started to see this pattern begin to reverse, where larger company stocks have started to outperform smaller company ones. This may be a 10-year trend starting to reverse. So again, perhaps signaled here by the inversion of the yield curve. So again, a balance in portfolios between large and smaller companies makes some sense after a long period of small cap outperformance. And then the last one of these three sort of takeaways from what are the investment implications is a focus on international versus U.S. I think this is the one that's going to catch most people by surprise. I think we could be on the cusp of international stocks beginning to outperform the U.S. So I went back here to 1983, not just to 1995 like I did in the other charts, because I wanted to show you this big period of international outperformance in the 80s. I don't know if you remember it, but there was a time when Japan was supposedly going to take over the world. I was in college in the 80s. I remember hearing about Japanese management techniques and manufacturing approaches and how we all needed to adopt them because Japan was going to do so well. Well, that didn't work out. In 1989, Japan peaked out, stock market peaked out, the economy peaked out, the real estate market peaked out, and in many ways is yet to recover. But we saw tremendous international stock market outperformance led by the rising blue line there until we got right around that yield curve inversion in 1989, signaling a switch where U.S. stocks began to outperform, and that rising orange line of U.S. stock outperformance continued all the way there until the early 2000s, another yield curve inversion, and we had another switch where the blue line began to rise and that orange line fell as international stocks began to outperform. But if we just focus on the last 10 years, it's all been about the U.S. The U.S. has outperformed once again by even more of a margin than international had outperformed back in the 80s. But now with another yield curve inversion, we may be at the point at which that begins to reverse. Valuations are very stretched between international stocks, even in the same industry, and their U.S. counterparts. And now, as we begin to rationalize those expectations, that may lead to a real turnaround here in international versus U.S. performance. So just another thing to think about as we go through a more challenging time, perhaps for the markets, maybe U.S. stocks might be a little bit more vulnerable than their international counterparts. So to sum that up, that's value might begin to outperform growth, large might outperform small, and international might outperform the U.S. or at least perform more in sync with U.S. stocks. And that's good news because diversification, I think, is going to be the best strategy for the next, let's say, year or so. Yeah, that is this slide right here. Check this out. This is maybe the most important thing I'm going to share with you today. This is a chart of correlation. Now, correlation just measures the degree to which two things move together, the degree to which they move in sync with each other. When it's high, the markets of the world move in sync with each other. This is the average correlation of the world's largest 20 stock markets. So when the line is high, when that number's high, it means everything's moving up and down together, as they did in sort of, from 2005 to say 2015. Everything kind of moved in sync. Right around that period of the financial crisis and its aftermath, stocks went up and down together. But if you look back to, or if you look to where we are now, that correlation's come down. The trend is really fallen, meaning there's more independence among the world's major stock markets, where when some zig, others zag, and that offsetting volatility is actually really good news for portfolios. We're kind of back to the level and the trend that we saw in the 80s and the 70s and even in the 90s, where diversification really paid off. When you went through a downturn, not everything went down together. And it wasn't about just being in or out of the market. It was really about being in all of the markets and making sure you were broadly diversified as a way to manage volatility and downside risk in portfolios. And it's back. Now, it's been 20 years since we've seen correlations this low. And anyone can be forgiven to think that diversification doesn't matter anymore. And with globalization, it's all gone away. But it hasn't. It's actually come back. And for a number of good reasons, we can go into this if we want to. But the point is that diversification across growth and value, large and small, international and U.S., I think is actually going to do a really good job in managing the potential volatility in the second half of this year and maybe next year as well. Shifting us away from this idea of just in or out to making sure we are broadly exposed across a lot of asset classes and really using that diversification to help offset the volatility in portfolios. And the last point on this, and on the next slide, we can think about diversification, but isn't the U.S. still just the strongest, biggest market in the world? Isn't the economy doing pretty well in the U.S.? And, U.S. companies have a lot of international exposure. Why do I really need to invest anywhere else in the world? But I can tell you that I hear that everywhere I go. Jim, in my introduction, talked about how I grew up around the world. It's true. I've grown up in many different countries. I visit them all the time. I'll be in China this fall, London earlier this year, and parts of Europe. And wherever I talk to audiences, I hear the same thing. Yeah, I hear about diversification, but the companies in my country, I just think they're the best. I think they have the most solid outlook. Take a look at this. Whatever country you're in, citizens in that country, investors in that country tend to concentrate most of their money in the stocks of that country. So I just highlighted the U.S. here, for example. About 75% of U.S. investors' portfolios are invested in U.S. stocks. So of their equity investments, about 75% are in U.S. stocks. And you might think, well, it seems reasonable. But everyone thinks that. Look right next to the U.S. I don't know if you can see this, but right next to the U.S. is Greece. Yes, Greek investors put 70% of their money in Greek stocks. Does this sound like a good idea to you? It is not a good idea. But that's what everyone does, no matter where they are. They tend to concentrate in their home country. You may look all the way towards the end of the chart. Netherlands, Austria, relatively low percentage of stocks in their home country, around 30%. But do you know what percent of the global stock market Netherlands stocks make up? It's less than 1%. So they're 30 times overweighted to stocks in their own country. Everyone overweights their home country, no matter where they live, because maybe they know the politics, or they know the companies, or they understand the economy a little bit better. They all think it's safer to invest close to home, and nearly all of them are wrong, particularly right now in an environment where the entire global economy is at that, remember that 99 threshold? The entire global economy is perhaps on the cusp of the next recession. It might be an abbreviated recession, nothing like 08 or 09, but it's one where broad diversification, I think, is really going to pay off much more so than concentrating in what may have been the best performers of the last year or two. So let me sum this whole thing up and then have a conversation with Jim here. Number one, let's watch that yield curve, the difference between long and short-term interest rates, and those leading indicators I highlighted for signs of a peak in the global economic cycle. You can follow me on Twitter. I post charts of them all the time, or on LinkedIn if you want to know in real time what's going on with those charts. expect some heightened volatility. I'm not saying for sure there's a bear market around the corner, but the second half of this year could be a bit more challenging than the first half of the year as we near the end of this cycle. And think about these reversals and these long-term trends. They could be near an inflection point, making diversification more important than it's been in 20 years. So thanks for staying with me on this. I probably ran a little bit long, but Jim, look forward to chatting with you on some of your thoughts.
Absolutely, and thanks so much, Jeff, for the prepared remarks. I just wanted to emphasize Jeff spent some time on diversification, and it's challenging or painful sometimes when you just see U.S. stocks going up and up and up and up, and you think, boy, why am I investing in some of these other areas, or why do I invest in other asset classes even? And it's just important, to present this information so that we can have this viewpoint on diversification is going to work. It does work. It continues to help us guard against the inevitable next downturn. We don't just want to keep plowing money into U.S. growth companies, because eventually that trend will turn around. And that's why our firm, as one of our key tenets, is to have this diversification across asset classes and then within asset classes. So thanks so much for that, Jeff. The question that we often get a lot too is, obviously these days, the things that can maybe exacerbate the problems that might cause the next recession are things like the geopolitical arena, the trade issues, the conflict with Iran potentially, these sorts of geopolitical events. What are your thoughts on that currently? What are some things that you always keep an eye on that maybe are a little bit different from some of the things that always gather the news headlines regarding that?
Yeah, great point. And, I often find that, markets and economics have more of an impact on politics and political outcomes than the other way around. I just take for a second and say, look, if we do slip into a downturn next year, I think that the debate, the discussions around, because another one of the things coming up is, the 2020 elections. I think the discussion around the 2020 elections and the policies will look very different if we've slipped into even a brief recession than what we're looking at today, with stocks at all-time highs and the economy still doing fairly well. The trade situation as well. As the economy begins to slow down, the Trump administration has shown a willingness to back off of trade threats as they begin to imperil the economy, and in particular the stock market. Very important things to consider, I think, if you're running for office in a year before a big election. So I think those are important to consider. The U.S.-China spat continues. It's not a huge factor as it relates to the economy here in the U.S., a bigger impact for earnings. So we're going to hear much more about it coming out of earnings reports in the next few weeks, the impact that trade is having on growth initiatives, on cost, on reconfiguring logistical supply chains, for example, for major manufacturing businesses. Then we're hearing at the global sort of economic level, or the higher economic level in the U.S., for example. It's having a bigger impact in China as well from a sentiment standpoint. So these are things we need to watch. But I'm encouraged by some of the things I've heard in recent weeks. So the Trump administration, for example, just recently unveiled targeted $4 billion worth of products coming out of Europe for tariffs. And I thought that was good news. Why would that be good news for the markets? Because it was all done through the World Trade Organization. So this is a dispute the U.S. is having with subsidies the EU is providing to Airbus. The big airplane maker. And the EU has similar concerns about how the U.S. supports Boeing. But the point is, it's all being settled through the World Trade Organization dispute mechanism, not unilaterally by a U.S. administration or by someone in Europe. Or, it's less of a political thing. It's more being decided on by an organization that's designed to vet these things. And has a long process to deal with them, and one that's generally pretty fair. So I kind of like the way the direction that's heading as it relates to Europe and Japan. If the U.S. were suddenly to develop similar spats it has with China, with Europe and Japan, that'd be very different in terms of the stock market impact and economic impact. But so far, I think that has remained fairly contained in its direct economic impact. Again, we're going to hear more about it in terms of supply chain and cost structure as we move through the earnings season. But if it doesn't escalate much from here, it's a drag, but one that probably by itself, trade isn't enough to cause the next economic downturn.
You did it.
Now, I know, I'm sorry, so I'll just jump. You asked me a bunch of other things too about Iran, you know what, you're right. I mean, gosh, there are a lot of geopolitical concerns about there, and I don't want to dismiss those. So let me just take 1 second to talk about them. These are ever-present issues. Geopolitics never go away. They just go out of the headlines for a while. And, I think right now, Iran, because of the fact that it can't really export, its oil exports are down 90%. It is struggling. It is likely to come back to the table on nuclear negotiations and agree to some new terms, but it's going to take a little bit. And in the meantime, they're going to look to try and interdict shipments of oil in the Gulf of Oman and other places. That doesn't seem to be having much of an effect on oil prices, which is the main route by which geopolitical risk in the Middle East is transmitted to the rest of the world. So that seems to have a lid on it at the moment. The South China Sea conflict also seems to be simmered down for the moment. North Korea, after firing another missile, seems to be, looking for talks. So, it seems like most of that is unlikely to erupt beyond maybe, having an effect on the stock market for a day or two and then fading a little bit, but certainly something we're keeping an eye on. There are a number of other issues as it relates to Turkey and several other countries as well, where there could be some geopolitical flare-ups. But for the moment, more focused on the trade issue and then the broad global economic condition.
And thanks for that. You did such a great job at the beginning talking about the whole world. And the only other thing, if we divorce ourselves from the U.S. just for a second, the only other kind of political and economic wrapped into one question is this whole Brexit mess. There's some agreement maybe on there's a global slowdown or at least a little bit of a slowdown in Europe and maybe Japan and some of these other areas. What effect, if any, do you think that this whole messiness around Brexit could maybe spiral the European Union down a little bit further and maybe even touch up the U.S. if it doesn't get resolved amicably?
Yeah, Brexit is a disaster for the UK, but may not be a disaster for Europe or the US were it to be a hard break from the EU, as they're currently on path to do. So we'll see how it all shapes up. Of course, they'll have a new prime minister by the end of this month, and we'll see whether negotiations resume and if there's any shift there. But at the moment, the expectation by the Bank of England, which I think has done the best job, most thorough job of all the analyses that I've seen of the economic impact on the UK, pegs the impact at about a 10% hit to GDP. Now, to put that in perspective, and most of that hitting within a year, 10% hit in 2008 and 2009, the global financial crisis that will affect our memories for the rest of our lives, that was a 6.5% hit to the UK economy. So this is way worse than the global financial crisis as it relates to their economy, mainly because it really curtails their ability to provide financial services to Europe, and that's about 40% of their economy. London is the financial hub of Europe and wouldn't be after all of this. It would go to Dublin or Frankfurt or Paris. So that's the major concern there. Would absolutely hollow out their financial services industry. All those jobs would go to the cities that I mentioned in Europe. Actually, probably be a net plus for Europe. So how would it touch maybe the U.S. or elsewhere? The concern would be maybe through the financial system, but it looks like they're adequately reserved. Look, the referendum took place in the middle of 2016. It's been 3 years for businesses to adapt to a Brexit environment. And they'll have additional time through October of this year to make additional contingencies, and then there'll probably be some phase-in for companies that still need some additional time. So maybe up to 4 years for many companies to adapt to this. So again, while a big negative economic hit to the UK economy and probably the UK stock market, which is a very, very small portion of the global stock market, the rest of the world may actually see a net benefit in terms of jobs in financial services, in manufacturing and other areas as the UK is negatively impacted. So, and that's one of the reasons why the EU is not quick to cave in to demands by the UK to make some concessions. They actually see this as a potential net benefit to them. So, so I don't think there'll be a lot of spillover. I don't think this is going to cause the next crisis. Outside of the UK, but it certainly be a painful one inside and result in darn near every politician losing their job. And that's, I think, another one of the reasons why they're really scrambling to try and come up with a deal at the end here, and may still come up with one because of the potential political consequences. So again, really bad for the UK, not so bad for everybody else.
Jeff, this is Nathan. Zooming back to the U.S. perspective, I know there's a lot of discussion and debate around which political party will have control and at what time and trends, et cetera. Could you just comment about the linkage or lack of linkage between the party in office and the financial markets in general?
Yeah, that's a great question. I can tell you that after spending lots of time over the years looking at this analysis and different combinations of parties in Washington, I can tell you that historically there has definitely been one party that has been the best for the stock market, without a doubt, no question about it, and that's the Whig Party. Any Millard Fillmore fans in the house? Yeah, we had 4 Whig presidents. Without a doubt, the Whig Party in the mid-1800s kicked butt, but really, Democrats, Republicans, there is no statistically important difference, nor is there really in combinations of House versus Senate versus White House. It really gets back to what were the economic conditions, much more so, in fact, entirely than the political ones, as I'm sure you were hinting at, Nathan. But so as we look to next year, what could happen? Certainly, markets don't like uncertainty, it's often said. And so if it looked like there would be the potential for sweeping changes, the market may begin to price that in into sectors like financials or healthcare or energy that are highly regulated. But it appears that the Senate, based on our contacts in Washington, the expectation is the Senate is unlikely to change hands. And that means that a filibuster-proof majority to making dramatic changes seems unlikely. Therefore, we don't expect dramatic legislative changes to take place, no matter what the outcome of the presidential election is next year, and that I think will keep the stock market from pricing any really dramatic outcomes as it relates to the more highly regulated sectors.
Jeff, I want to thank you for your input and engaging conversation. You've always got great insights. It's timely. We're at all-time market highs, and there's a lot going on in the world. So it's comforting knowing that your voice is cutting through a lot of the noise to bring clarity about what's important and what matters. So I truly want to thank you.
The honor to be on the call. Thanks for the opportunity to share my thoughts.
And I want to thank everyone for attending today. You've been so kind to listen in, and we look forward to continuing the conversation with you. Our firm is well equipped to serve your needs, and we lead all of our discussions and our work with building a financial plan customized for you. And then we let the investment strategy follow the plan. We don't want to take more risk than necessary for you to reach your financial objectives. So we really focus on the roadmap, building out the steps to reach your financial destination and make sure your portfolio is aligned to that. We're focusing on diversification. We're focusing on tax efficiency and cost awareness and multiple levels of asset classes so that everything is so spread out from a risk management standpoint that we want to make sure that you have that confidence that we review this for you on a regular basis, and that we rebalance things and make sure your cash is allocated according to your specific needs. So we ask for your feedback at any time around this webinar or any ideas or conversations that you'd like us to continue and provide to clients and guests. And we really appreciate your input. So I want to thank you for attending. Thank you again, Jeff, for your wisdom and encourage everyone to follow up with any questions directly to us. We welcome those questions, and we also look forward to continuing the conversation. Thank you, and have a great rest of the day.